Last video, I told you the hard truth. Meme coins are a trap. The 100x dream is a psychological exploit. And if you're chasing dog coins hoping they rescue you from your 9 to 5, you're not investing, you're gambling with money you cannot afford to lose. Hopefully that landed. But I know what you were thinking when that video ended. Okay, fine, you took away my dream. Now what? That's exactly why we're here today. Because I'm not just here to tell you what not to do, I'm here to hand you the actual blueprint, the strategy that doesn't require luck, connections, or a trust fund, the one that regular people with regular incomes and regular lives, have used to build life-changing wealth. It's called dollar cost averaging. And before you close this tab because you think you've heard of it, I promise you, you have not heard it explained like this. Here's the question I want to answer today with exact math and zero hype. Can a regular person, not a tech bro, not a hedge fund manager, not someone with $50,000 sitting in a savings account, can a regular person accumulate $100,000 worth of Bitcoin in 5 years? The answer will surprise you, but only if you're willing to fall in love with boring. Let's break this down from the ground up. Let's start with the basics. What is dollar cost averaging? Simple definition, you buy a fixed dollar amount of Bitcoin at regular intervals regardless of price. That's it. That's the whole strategy. Every week or every month, depending on your income, you buy X dollars of Bitcoin. When the price is high, you buy a little less Bitcoin for your X dollars. When the price is low, you buy a little more Bitcoin. You never try to time the market. You never wait for the perfect entry. You just buy, consistently, automatically. Now, I can already hear the objection forming in your head. But what if I buy right before a crash? And this is exactly where we need to talk about why your brain hates dollar cost averaging and why that hatred is a sign that it's exactly what you should be doing. Remember what we covered last time? Variable reward conditioning. Your brain is wired to hunt for the perfect moment. It wants to buy at the absolute bottom and sell at the absolute top. It wants the dopamine hit of making the right call at the right time. DCA offers none of that. DCA is boring, deliberately, strategically, gloriously boring. And here's the psychological breakthrough I need you to have right now. Boring is a feature, not a bug. Let me introduce you to a concept from behavioral economics called present bias. It's our tendency to overvalue immediate rewards and undervalue future ones. $1 today feels worth more than $5 in 3 years, even when mathematically it's not. This is why lottery tickets sell. This is why meme coins pump. This is why people choose the $500 tax refund splurge over the $500 investment. The immediate, tangible reward beats the distant, abstract future payoff every time in the human brain. DCA works because it defeats present bias through automation. When you automate a Bitcoin purchase, you remove your emotional brain from the equation entirely. You make the rational decision once, when you're calm, informed, and thinking clearly, and then you let the system execute it forever, regardless of how you feel in the moment. You can't panic sell what you forgot you were buying. There's a second psychological principle at work here: loss aversion. Behavioral economist Daniel Kahneman proved that the pain of losing $100 is psychologically twice as powerful as the pleasure of gaining $100. We feel losses harder than gains. This is why people freeze during market dips, why they sell at the worst possible time, why they watch Bitcoin drop 30% and convince themselves it's going to zero right before it doubles. DCA neutralizes loss aversion too, because every single dip in price is literally, mathematically good for you. When the price drops, your fixed dollar amount buys more Bitcoin. The dip isn't a disaster. The dip is a discount. Your broke brain screams sell. Your DCA strategy quietly replies, thank you, I'll take more. All right, time for the math that's either going to excite you or humiliate you. Either way, it's going to be honest. Let me show you 3 different scenarios, 3 different income levels, 3 different monthly investments, all using the same DCA strategy. all targeting the same goal, $100,000 worth of Bitcoin in 5 years. Scenario A, the tight budget investor. Monthly investment $200 a month. That's roughly $50 a week, less than most people spend on subscriptions they don't use. Over 5 years, your total out-of-pocket investment is $12,000. Now here's where Bitcoin's historical trajectory matters. Over its last 10 years, Bitcoin has averaged roughly 60% compound annual growth. I'm not going to use 60% for our projections because I believe in conservative math. Let's use 30% annually, which is, by the way, still less than Bitcoin's verified 10-year CAGR. At 30% annual growth, your $200 monthly DCA over 5 years grows to approximately $27,000. Solid, not $100K, but you more than doubled your money on $200 a month. That's the floor. Scenario B, the middle ground investor. Monthly investment $500 a month, $125 a week. This is the person who watched the last video, cut their meme coin habit, canceled 2 streaming services, and redirected that money here. Total out-of-pocket over 5 years is $30,000. At 30% annual compounding, your portfolio grows to approximately $67,000. Getting closer, but here's what changes the game entirely. Scenario C, the committed accumulator. Monthly investment $1,000 a month, $250 a week. Before you say, I can't afford that, let me challenge you, and I mean this respectfully, to audit your actual spending before you decide what you can and cannot afford. The average American household spends over $300 a month on dining out, over $200 on entertainment subscriptions, over $400 on impulse purchases. I'm not telling you to suffer, I'm telling you to look at the numbers. Total out-of-pocket over 5 years is $60,000. At 30% annual growth, $135,000 from $1,000 a month from patient, boring, automated accumulation. No trading, no timing, no stress, no 2 a.m. price checks. And here's what makes these numbers even more powerful, and this is something most DCA calculators completely ignore. Bitcoin halving cycles. Approximately every 4 years, the rate at which new Bitcoin is created is cut in half. This is coded into Bitcoin's DNA. It's not a rumor, it's not speculation, it's mathematical certainty. When supply growth slows and demand stays the same or increases, basic economics says price goes up. Every single Bitcoin halving in history has been followed by a significant bull run within 12 to 18 months. The last halving was in April 2024. We are currently inside a historically powerful accumulation window. This doesn't mean you try to time the halving. The entire point of DCA is that you don't need to, but it does mean that the next 5 years represent one of the most statistically compelling windows in Bitcoin's history to be a consistent accumulator. Now, let me address the one number everyone always asks about. What if Bitcoin drops, like really drops, during your DCA window? Let's run the brutal scenario. What if Bitcoin drops 50% in year 2 of your 5-year plan and stays low for 18 months before recovering? This is not a hypothetical. This has happened multiple times. Here's what happens to your $1,000 monthly DCA investor in that scenario. During the crash, they buy more Bitcoin per dollar than at any point in their plan. Their average cost basis drops significantly. When Bitcoin recovers, and it has recovered every single time to new highs, they don't just break even, they are ahead. The bear market is the opportunity. For the DCA investor, every crash is a flash sale. This is why I say DCA isn't just a strategy, it's a superpower, but only if you have the psychological discipline to keep pressing the button when everything around you is screaming to stop. Here's where most people fail. Not on the math. The math is simple. Not on the setup. Setting up an automatic purchase takes 10 minutes. They fail on month 7 when Bitcoin is down 35% and their coworker is laughing at them. They fail on month 14 when a new altcoin is all over Twitter and their DCA feels slow and invisible. They fail when the feeling of falling behind becomes louder than the math of staying the course.
This is what I call the noise wall, and it is the single biggest threat to your wealth building plan, bigger than any market crash, bigger than any bad investment. The financial internet is an attention economy. Fear sells, hype sells. Certainty, the kind of slow, boring certainty that DCA delivers, does not sell, so it doesn't get made. And because it doesn't get made, you never see it. And because you never see it, your brain starts to think it doesn't exist. But it does. And the people who are quietly getting rich are the ones who stopped listening to the noise and started listening to the math. Let me give you 3 psychological anchors, tools to hold on to when the noise wall hits. Anchor 1, the zoom out protocol. Whenever you feel the urge to panic, whenever Bitcoin is down and your brain is spiraling, zoom out the chart. Don't look at the daily, don't look at the weekly. Look at the 4-year view. Every single panic moment in Bitcoin's history, every "this time it's really dead" moment,
looks like a tiny blip on the 4-year chart. Every one. Anchor 2, the cost basis reminder. When Bitcoin drops 30% and you feel sick, open your portfolio and look at one number only. Your average cost basis, not the current price, your average entry price across all your purchases. Because of DCA, your average entry is always lower than you think. And when Bitcoin recovers, and it has recovered every single time, your gain from your actual entry is always larger than the headline number suggests. Anchor 3, the opportunity reframe. Every time Bitcoin drops during your DCA window, say this out loud. That just lowered my average. My 5-year plan is intact. I'm buying more for the same money. That is not toxic positivity. That is accurate. That is the math talking. Let the math be louder than your anxiety. Okay. Let's make this completely, actionably real. No theory, just the exact blueprint. Step 1. Define your monthly number. Go through your last 90 days of bank statements. Find the money that leaked. The subscriptions, the impulse buys, the dining out excess, the meme coins. Be honest. Most people find between $200 and $800 in monthly leak when they actually look. That's your DCA starting amount. Not money you're sacrificing, money you were already losing to nothing. Step 2. Choose your platform and automate. Use a reputable, regulated exchange that offers recurring, automatic purchases. Set your Bitcoin DCA to execute on the same day every week or every month if that's what your budget requires. Weekly is statistically better for averaging, but monthly is infinitely better than never. Step 3. Set up cold storage for anything over $5,000. This is non-negotiable. If your accumulated Bitcoin exceeds $5,000, move the majority to a hardware wallet, not your exchange, not a hot wallet, cold storage. Your exchange is a convenience tool, not a vault. Step 4. Set a review schedule, not a monitoring schedule. Review your DCA plan once a quarter. Check that your income and expenses still support your monthly number. Adjust if needed. That's it. You do not need to check Bitcoin's price daily. You do not need a price alert. You do not need to be in Telegram groups. Your job is to buy and hold. The plan manages itself. Step 5. Protect the plan from yourself. Tell one person you trust about your DCA plan, not to show off, to create accountability. Research shows that people who verbalize a financial commitment to another person are significantly more likely to follow through. Better yet, write your 5-year goal on a piece of paper and put it somewhere you'll see it, not the price target, the reason. What does $100,000 in Bitcoin actually mean to your life? What does it unlock? That reason is your armor against the noise wall. Here's the last thing I want to leave you with. The goal isn't $100,000. It never was. The goal is options. The freedom to say no to a job you hate. The ability to take a year off without financial panic. The security of knowing that regardless of what happens in the economy, you hold an asset that no government can inflate away and no bank can freeze. That's what a disciplined Bitcoin DCA strategy actually buys you. Not a number, a life.
The people who build that life don't do anything extraordinary. They don't have special access. They don't get lucky. They simply commit to buying a small amount of a scarce, hard asset every single week, without exception, while everyone else around them chases the next miracle. Boring, consistent, unstoppable. If you're starting your DCA today, drop a comment. Tell me your monthly number, even if it's $50. Especially if it's $50, because $50 a month from someone who couldn't afford $51 is worth more than $5,000 from someone who never had to think about it. This is how real wealth gets built, not in one trade, in thousands of quiet decisions. Subscribe, because next week we're going deeper. We're talking about when to increase your DCA as your income grows and how to structure your entire portfolio around a Bitcoin core. Stay the course. The math is on your side. I'll see you in the next one.